The accounting equation says that at any point in time, your assets will always be equal to liabilities. Assets being what things that we own, that the business owns, and liabilities is what the business owes. The business owes. The business owes money to the people from which it borrows, to the people from whom they have purchased on credit, and also the proprietor. Remember, one of the concepts that we discussed was the entity concept, where the proprietor and the business are two separate entities. So when a proprietor brings in money to the business, it's as if the business now owes this money to the proprietor. Therefore, the business has a liability to the proprietor. It has a liability to its owner. And this liability to its owner is often called capital. Capital is nothing but capital represents the proprietor's account, the owner's account. So assets equal to liabilities. These liabilities may be to the owner or maybe to the third parties. So we split that and we say assets equal to liabilities, which represents only liabilities to third parties, and capital. So assets equal to liabilities plus capital. Rearranging, we could also say that assets minus liabilities is equal to capital. Assets, I repeat, is what the business owns, maybe the land, the machine, the furniture, the cash, etc. or money that it is supposed to get from its debtors. That is what the business owns. And what it owes, maybe to its creditors. What its creditors? If we have bought goods, the business has bought goods but has not paid the suppliers as yet, they are the creditors. Or the business has borrowed money from the bank. So there is money which is payable to the bank. Those would be the liabilities. So assets are what the business owns. Liabilities are what the business owes. And assets minus the liabilities is nothing but capital. It is what belongs to the owner, the net worth of the business. We can expand this a little further and say that assets minus liabilities is equal to capital plus income minus expenses. When a business makes profits, that profit actually belongs to the owner. The owner is the person who has started the business. All the profits go to the owner. And if the business makes losses, it is the owner's share that is going to come down. So in a way we can say whatever profits or income is made, whatever profit or income is made belongs to the proprietor. It will be added to the capital because capital is nothing but what the business owes to the proprietor. Similarly, if there are expenses or losses, these would be deducted from the dues of the proprietor. This equation could also be arranged as assets plus expenses, right, is equal to capital plus income plus liabilities. Assets plus expenses is equal to income plus liabilities plus capital. This would mean that the treatment to asset and expense, the treatment of assets and expenses is the same. I mean, they fall on the same side of the equation. Whereas income and liabilities, capital being also a liability of the business to its owner, fall on the other side of the equation. Now, how do you distinguish an asset and an expense? We had partly covered this under the going concern concept. For example, when a business buys furniture, they intend to use the furniture maybe for 3 years or maybe for 5 years. When the benefits of such an expenditure are to be received, not only in the current year but also in the subsequent years, it is called an asset. So when the benefit of an expenditure is going to be received in subsequent years, we call it an asset. But if the benefit is expected to be received only in the current year, it's called an expense. Like I said, if I buy furniture, if the business buys furniture, they will expect to use the furniture for 3 years. Since the benefits of this purchase of furniture will be there the next 2 years, furniture would be called an asset. Suppose the business buys stationery, some paper, some pencils, some pens, etc. This stationery they intend to consume within that year. Therefore, the purchase of stationery, though you've bought paper, pens, etc., that is not called assets. Papers, pens, etc. are not called assets. They are called expenses. So basically, how do we distinguish asset and an expense? Asset, if the benefit of that expenditure is got in subsequent years, it becomes an asset. If the benefit is received only in the current year, then it becomes an expense. So the treatment asset and expense, if you notice, please remember, lie on the same side of the equation. Whereas income and liabilities lie on the other side. Income basically belongs to the proprietor. Any profits belong to the proprietor. And what is belonging to the proprietor? The due to the proprietor is represented by what is called the capital account. Liability, on the other hand, could be what the business owes to others besides the proprietor. So assets and expenses on one side, liabilities and income on the other side. Let us understand this with a few examples, whether it really holds true, how the accounting equation is satisfied in every situation.